Hi, welcome to our Tricio podcast, and we're also going to make this into a YouTube video. I'm Jerry Salaya. I'm Tricio's chief strategist, and I'm interviewing John Caverly, Tricio's chief economist today, because we're going to be speaking about bubbles. Hi, John.
Yes, so my name is John Calverley. I'm a chief economist at Tricio. I spent much of my career at American Express, starting as an economist, becoming chief economist. Later, I worked at Standard Chartered, head of macroeconomic research. During that period, I was mostly working with American Express and then Standard Chartered's private bank, and to some extent with other investors, hedge funds, real investors, etc. So mostly on the buy side. During my career, I was also chairman of the Society of Business Economists, now called Society of Professional Economists, and had various other roles, the European Money Forum, also a member of the US National Business Economic Issues Council, so various roles.
But now we're going to go down memory lane, which is relevant because back in 2004, you published a book, right?
Correct.
And what was the title of the book, John?
Bubbles and How to Survive Them.
Did you survive?
I survived. Yep.
Very good. All right. I just remember you were on TV a heck of a lot from 2004 up until like 2006. Is that right? Remember the UK housing bubble and stuff? Because I remember seeing you being interviewed.
Yeah, we had a promotional tour in the UK and also in the US in late 2004. And then I sort of became known as Mr. Bubbles for a while. And so during that time, obviously, housing markets were going up in the UK still and in the US. And people kept asking me about them.
But you were resilient because during the 2004-2007 period, the markets were just going up. I was like, Elon Musk of Tesla, stonking was a word, right? Because shares made new highs, house prices went up, but yet you persisted in saying, watch out, guys, there's something wrong here.
Yeah, I mean, the trouble with bubbles is that they can expand for much longer than you think feasible. I mean, if you think of the definition of a bubble, to my mind, it's simply that prices have become out of whack with fundamentals. But the point about a bubble is that they keep on getting out of whack and they get more out of whack, and it can last a very long time. So just because you see a bubble or think you see a bubble doesn't mean that it's going to crash the next day or the next week or even the next year. It just means that it's already outside fundamentals.
That's a very, very good way of putting it, John. Thank you. Now, again, down memory lane. Do you remember March 2007 in Edinburgh?
Yes.
The SB and Bloomberg put together a seminar for a bunch of clients. And then, and Edinburgh means that they captured most of the Scottish fund industry. So we had a lot of big names there. And I was there as like the warm-up act, talking about currency markets and ducking and diving and stuff. And I left them nice. The audience was well prepared for you. They were happy. They were chilled. They were all, content. Then you stood up, and this is my memory of it, of course, and in the period of like half an hour to 45 minutes, showed slide after slide of what was happening in the U.S. housing market, which wasn't sustainable. And I tell you, you killed that audience. And I'm not saying that in a good way. These guys were saying, what? We're happy with stock markets going up. We're happy with house prices going up. And you were saying such meaningful stuff is the only way I can describe it in terms of economic analysis, in terms of background and data, and basically numbers, that they were left thinking, yeah, all right, we got a problem. Was that your intention?
Yeah, well, by that time, of course, the US housing bubble was already starting to pop. Prices actually peaked in 2006, and I think it was already evident that they were starting to come down. And the worry then was that as those prices came down, that would create a lot of problems in the whole economy. And that's, of course, exactly what we saw. Because if you go back to 2004, when I wrote the book then, I argued that the US housing bubble was starting and probably had a lot further to go, which was exactly right. And I worried that it could become a big problem in the end. What eventually transpired was really my worst case scenario. I'd hoped that wouldn't happen, but it went up so much between 2004 and 2006. And then it turned out that there was so much rash lending, all the subprime, all the leverage that we saw, and that led to the fact that the housing market took down the whole banking system nearly.
That's right. It took a long time for the economy to recover, not just the U.S., but the global economy.
Yeah, I mean, there were policy mistakes as well. The failing to bail out Lehman was a huge mistake, and that led to the worst of the recession. But these things happen.
Do you think, quote unquote, we, both financial markets, retail investors, and regulators, and the people that regulate, the banks and the funds, have learned from their mistakes?
Yes, I do, actually. I think there's been a lot of progress now in trying to really deal with financial stability in general. So, what the central bankers have done now is they've said, okay, interest rates, monetary policy, that is still aimed at inflation and the economy. But now we need financial stability policy. So we play about with capital ratios for banks, we play about with rules on mortgage lending, trying to control housing bubbles, even commercial real estate bubbles. They don't do so much on the stock market side, but that's because they still tend to think that a crash in stocks is not necessarily going to bring the economy down. It does tend to be crashes in real estate that brings economies down.
Okay, that's a really good point, and that's something for people to keep in mind as we go through the next few years, I would suspect. So, John, I know you've written another book as well. I think that was written after the credit crisis.
Yeah, what that was essentially was an "I Told You So" book, which came out in early 2009. Really, as a second edition, effectively, but updating and saying, look, it's happened. What to expect now. At that point, of course, one had to start getting more bullish because once things went down, then eventually they'd come back up again.
That's again a very good thing to keep in mind, and that's something that at Tricio you brought to our attention. I think it was in April and May, 2020, where you were saying, guys, we had a big crash, but the authorities are doing really good things here, and maybe we should either one maintain weights in asset classes like UK stocks and US stocks, which we did because of you, and also start to look for the upside, which again worked out pretty well because as you've seen, the recovery has been astounding.
Right.
So well done. Thumbs up. You can't see them. Thumbs up. Now, can you share your bubble list with us, please?
Yes, let me share this. This is a list that I developed for my book. It's actually borrowed from Stephen King, but developed substantially from there. So basically what it is, if I can explain it, it's a checklist for bubbles. Because one of the problems in identifying a bubble is there's no simple way to tell whether something is a bubble or not. You can't just have a simple sort of mathematical tool or simply look at valuations. Sometimes high valuation is justified. So what this does is look at a whole range of different things and ask if you've got most of these ticked, then the chances are you have a bubble. And some of them are about valuations. So for example, rapidly rising prices is a flag to start with.
All right, one second, John, because we're doing a podcast as well, just for people who don't have access to the YouTube video. What John is showing us here is from Tricio's website, tricio-advisors.com, and the blog section, I believe, right, John?
It's in the blog, yeah.
Yep, and it's a checklist for bubbles, and it has 15 things to look out for. And if it's okay with you, John, we'll go through them, from number 1 to number 15. Is that all right?
Sure.
All right. Number 1 is rapidly rising prices.
Right. So obviously, usually people don't worry about a bubble if prices are not rising fast. Although there is a point sometimes in a bubble where they're high and they stay high for a while and then they crash. But usually it's when prices are really bubbling that people start to think about a bubble. Number 2 is high expectations for price rises. That's obviously harder to tell, but if everybody is bullish, if everybody thinks that prices will keep on going up, if your taxi driver is telling you, stock market's the place to be or housing's the place to be, that's a signal to get concerned. Third one is valuations, overvaluation versus history. So again, there's various ways of looking at both stocks and property. You can look at property in relation to rents, for example. You can look at housing in relation to people's incomes. And if it's very high compared to where it's been historically, that could be a concern. With stocks, you might look at the cyclic adjusted price earnings ratio, for example, from Robert Shiller. This takes the last 10 years of earnings and compares with the current price. And when that's high, that could be a concern. So you're really trying to see where valuations have been in the past Where are they now? If they're very expensive now compared with the past, that's a concern. Number 4 is overvaluation versus rationality. So if it looks as though this market, this stock or this segment of the market is wildly overvalued based on what seems to be rational expectations for earnings over the future, for profits, for the outlook for that company, for example, then again, it's a flag. The 5th one, several years into a business cycle. Now, typically, bubbles occur late in a business cycle. That's because usually a recession makes people cautious. Usually stocks go down in a recession anyway, so does housing. So it usually takes a few years for people to get comfortable, to get caution, to lose their caution, start taking more risks. So typically you only see a bubble several years into a business cycle. And that's sort of what we saw with the stock market bubble in the mid-2000s. The 6th one, a new rationale for higher prices. This is an interesting one. I mean, typically there's some reason that people put forward for why it's different this time, for why this particular market or stock or whatever housing should be higher than before. So it could be something like we're in a much lower interest rate environment, or it could be in the US, for example, it was the fact that that mortgages were now available to a lot more people. That was driving prices. It could be something to do with scarcity, but there's usually some kind of rationale, and that rationale does usually make sense up to a point, but then usually prices go way beyond that.
So that would be like the .com era where everybody was looking at new technology, things like that, John?
Yes, I mean, if you think of where we've been over the last year or two, I think the rationale for tech stocks being high at the moment is that they're not affected by COVID directly, and indeed they've been boosted by the COVID effect, and the anticipation that even when we defeat COVID, that people will still work from home more, and they'll still be using Zoom and using online shopping and so on. So it's a big fillip for tech stocks. Number 7 is talk of a new paradigm. I would say right now the paradigm is that we have negative real interest rates. So in the US, for example, the 10-year TIPS yield, the inflation-protected bonds, what is it, about -0.75% at the moment? So negative real interest rates. Now, if you think that stocks, companies' revenues and their profits will go up with inflation, but then you're going to discount at a negative interest rate, that means that future earnings are worth a lot of money, far more than if you had a positive interest rate. And that, I think, has been a key thing driving particularly tech stocks, and also particularly stocks where they haven't even got any earnings yet, because you don't have to worry about the earnings the next couple of years if they're not there. But if you think they're going to make earnings 10 years, 15 years, even 20 years down the road, and you're discounting that with a negative interest rate, you almost can't go wrong.
That sounds like dangerous thinking, but yes, I see your point.
Yeah, I mean, obviously the danger is that some of those companies may never make profits. There's
Yes.
obviously question marks over those. I'll come on to talk about that in a moment. Number 8 is new investors drawn into the market. We obviously saw that with the housing bubble in the US back in the early 2000s, when we had all the subprime borrowers coming in, people who previously would only have rented. Suddenly they were able to get mortgages, and that made a huge difference. And in stock markets over the last year, we've seen a lot of young people drawn in by zero pricing for trades. I think that's brought in a lot of new traders. Number 9 is new entrepreneurs in the area. In housing, we saw that with people coming in and offering seminars on how to flip houses. I guess in stocks, we've obviously seen the SPACs, the SPACs. So these things have really brought in some new people into the area. Number 10 is strong popular and media interest. Again, with the housing bubble, we saw that big time with loads and loads of TV programs, regular pieces in newspapers. I guess online was still developing at that point, but coming. And recently we've seen that in the stock market, huge amount of media interest in the rising stock market. A lot of those articles are often saying, "Isn't it a bubble?" or "It is a bubble," but that's part of the interest. So when you see that, that's a concern. If you tick that, it's a worry. Number 11 is rapid credit growth. Credit growth, of course, particularly important if you're talking about a housing or real estate bubble, but also in the stock markets. If people are borrowing rapidly, obviously that's going to drive real estate prices. Tends also to drive stock prices as well. Number 12 is new lenders or new lending policies. Well, I've already mentioned the subprime back in the early 2000s. With stocks, I mentioned also the zero cost for the trading. So you're getting new ways to enter the market, in effect.
And then you're looking at this as a broad spectrum across the economy. You wouldn't be particularly pointing out family offices that managed to get leverage of 3 times plus and blow $10 billion worth of losses into banks and brokers over the last few weeks, right? Without naming names. I mean, that was sort of old lending policies being blended in with new lending policies for something that seems to be not as regulated as heavily as hedge funds or other traditional funds are.
That's part of it. I mean, that's part of the rising credit, isn't it? It's not necessarily a new policy, but yeah, when you see a lot of margin lending, when you see a lot of leverage, that's a sign of potential trouble. Number 13 is a relaxed monetary policy. Obviously, in the early 2000s, U.S. interest rates were kept low for quite a long time. In 2001 to 4, only started to raise them then. Currently, obviously, to deal with COVID, interest rates are very low, and we've got quantitative easing, so relaxed. Number 14 is a falling household savings rate. Now, this is important because really it signals that households are very confident. It's also partly due to the fact that they're borrowing anyway, because the way the savings rate is calculated, if people borrow, then that lowers the savings rate. Right. But it's a signal, basically. It's a signal that people are confident, they're borrowing, that they're spending, and they're not saving very much.
Now, I know that because of the COVID pandemic and the way that some support has been given in the U.S. in terms of stimulus checks, and in the UK, furlough, options for some companies that, were maybe thinking about laying people off, but they can take advantage of the government programs instead. Maybe the falling household savings rate isn't a huge factor just yet. But do you think that could come back into play?
You're right. I think it's rather confused at the moment because the savings rate went up, particularly in the US, because there was this huge flood of new income created by the government given to people. At the same time, people pulled back from spending, partly because they were cautious, partly because they couldn't spend, couldn't go out. So you got this big rise in the savings rate. I mean, the fact that the savings rate has been coming down since last spring is perhaps a signal. Although I'm not sure if it's completely irrelevant at the moment.
Okay.
I think it'd be fair to say that confidence is rising quite quickly at the moment, and that is a support for stocks and also for housing, clearly. I'm not sure I'd make too much of this one this time particularly. The last one is a strong exchange rate. I mean, we saw that back in the early 2000s when the dollar was strong. Dollar's been a bit strong recently, although it was weaker last year. The rationale behind this one is that a strong exchange rate means that interest rates are relatively high in that country compared to others, and money is tending to come in. So, it tends to go with a bubble. You also get a current account deficit very often because the exchange rate is strong, a trade deficit, current account deficit. So one to watch again. I mean, I'm not arguing that the US stock market as a whole is in a bubble at the moment. I would not argue that. And the reason for that, I think, starts from the valuations, that with interest rates so low, with negative interest rates on bond yields, I think it's okay for valuations to be relatively high compared with the past. I don't think the US market is especially attractive for the medium run anyway. And there's obviously a lot of momentum just at the moment. But if I was looking at it over a 2, 3, 5 year view, I think other markets are more attractive just because the US market is expensive. But I don't see the US market as a whole in a bubble. I think
But there might be segments of the market that are quote unquote
yeah,
bubbly.
exactly. I worry about the technology area, which went up a lot last year. And although we've seen a rotation to some extent over the last few months, more towards the value side, more towards the stocks that will do better when we get rid of COVID, actually technology stocks, many of them continue to rise. And we've also seen a lot of really bubbly activity in some of the IPOs, for example, some of the pricing there. So I worry about that.
Okay.
I'm also
Yep.
starting to get a little bit concerned about the US housing market, although I think we're still in the early stages here. The US house prices relative to other prices, so just in real terms, are pretty much back up to where they were at the peak in 2006. Real incomes are not much higher in the US, I mean, even once we get past COVID. So it's starting to look as though US house prices are relatively high. I think that's got further to go, frankly. I think house prices will keep rising for a few more years. But I think that's one to watch for the medium term.
Okay, so it's basically it's a warning signal rather than a run from this market right now signal.
Yeah, and one of the factors here is that when you start looking at property cycles, there is something like an 18-year cycle in property. I mean, this was first observed in the 1930s, oddly enough. And one of the things I looked into in my book was whether this works, and it remarkably it does. It's not exactly 18 years. It can be as little as 16, can be as many as 20, but it's quite often you get that kind of cycle. Now, the last peak in the US was 2006, so 18 years would be 2024. Potentially as early as next year could be a peak after 16 years. So I think that's one to watch.
Now you've got me worried. Thanks, John. I know
Yeah,
the guys in Edinburgh felt.
but let me just say it doesn't necessarily mean that a correction there is going to have the same effect as it did in 2008, because the banking system is much better protected now. Capital ratios are much higher. There's generally more caution. So at the moment, I mean, if house prices in the US fell 30% over the next 2 years, I wouldn't be terribly worried, because I think US banks are fairly well protected.
And just for the podcast, people who can't see it, the slide that John is sharing with me has the titles of his books: Bubbles and How to Survive Them in 2004, and When Bubbles Burst.
Bubbles and How to Survive Them was the first book, and then When Bubbles Burst is the follow-up.
In 2009, yeah?
Correct, yeah.
Okay, that's good. All right, John. Very good. Thanks, John.